All right. Well, Vetri Subramaniam is with us, Managing Director and CEO Designate at UTI AMC. Vetri, good to have you with us here. So this 50%, I guess, without putting numbers, how much was that responsible for us to do a few things here on the GST, etc.? But it's good we did it in terms of lowering taxation on a range of products. And now on the external front as well, there seems to be a bit of de-escalation, some light at the end of the tunnel in that sense. How does it set us up in a good way, decent way? Earnings growth, of course, has to pick up, and that's the big one. But there's a bunch of things together which have to come together, right?
Sure. Thanks, Prashant. I'd just step back for a moment to say, I think India has put itself in a good macroeconomic situation in terms of the way we've managed monetary policy, the way we've managed fiscal policy. We know that the economy was not, firing all cylinders late in 2024, but we've been able to use the strong macroeconomic platform to cut rates quite significantly. We were able to cut the income tax rate in the budget, which means we were putting more money into the wallets of people. And now we're effectively increasing their spending power by cutting GST. None of this would have been possible if you hadn't managed your macroeconomic situation in a prudent manner. Now, talking about the tariffs, I do think that eventually it is transactional, it is not structural. So yes, there will be some impact on the economy, some impact on earnings, but really we're discussing quarters. We're not really discussing something which is very long term. At least that's the base case with which we've been thinking about it. So yeah, we were never too worked up about the tariff issue. And it's good to see that the government is doing whatever it can at the margins to be supportive. And yes, dil mange more. So we'd always be happy to see the government doing a lot more, particularly in terms of ease of doing business. I think, that remains, to my mind, the big ask.
Well, that's always going to be welcome, Vetri. Morning. Thank you so much for joining in. And congratulations to you, by the way, on the change and the elevation. But dil mange more is absolutely fine. But till now, what the dil has received, what can that translate into?
Just one thing. Sorry, apologies.
Yeah.
Sorry. President Trump. So President Trump posted in the morning, right?
Yeah.
The tweet. Prime Minister Modi responded.
Reciprocated.
Yes. President Trump has posted Prime Minister Modi's tweet. He's picked up Prime Minister Modi's tweet and posted that on Truth Social.
Saying what?
He's just posted it on Truth Social.
On
Truth Social.
Truth Social.
Okay. So I think it's interesting. It's basically, overture, reciprocation, affirmation.
Something. Now, we won't know behind the scenes. That's why diplomacy is so interesting. But something is completely clicked in the last 10 odd days. Whatever it is, it's good. It's good for both the countries, for the relationship, and definitely for the market. We'll actually, put up those posts in just a bit again, the ones that Prashant is referring to. Prime Minister Modi responding to President Trump, and now President Trump basically posting that tweet, which was originally on X. So, okay, that was the first tweet that came in late last night. Now let's move to Prime Minister Modi's response, which was on X, on a different platform. This was on Truth Social. Prime Minister Modi acknowledged what President Trump said. There we go. And now what has happened is that Prime Minister Modi's tweet or the X post has been put on Truth Social for all of Donald Trump's followers. So this is good.
A lot of social media activity.
And they track every single thing. Who's meeting whom, who's taking pictures where, who's shaking hands with whom. So yeah, very, very active gentlemen out there. Okay. Well, in this environment, Vetri, to come back to my question, right? So this is really good. From a sentiment point of view, this is what the market wanted, and it seems to be happening. We've had enough on the local front as well. Now, how does all of this translate into better earnings growth? Because at the end of the day, that's a key reason why markets have been subdued and why FIIs have been staying away. So how much better can the rest of this year be compared to earlier estimates?
Yeah. First of all, Surabhi, I always thought there was too much financial chatter on the platform called X. Now I'm surprised to see that even foreign policy is being played out in real time.
Don't say social media.
So this is the world we live in. We've got to deal with that. Coming back to your point on earnings, right? I think one of the things we've got to keep in mind is that all the prudence that I talked about in terms of the way we are managing the economy also means that actually in terms of nominal growth, when you in fact look at the data for the quarter gone by in June, nominal GDP growth was barely at about 8.5%. Then you look at the Nifty 500 group of companies, revenue growth for that universe is just about 6%. And profit growth is again just about 6.5% for that entire universe of companies. And if you look at the number of companies who are able to grow their revenues, let's say about 10%, that number is stuck at about 40%. Actually, that's the number for earnings. So just about 44% of companies out of the 500 able to grow earnings at greater than 10%. Now, I think that is a little bit of a challenge, because when you start with starting valuations that you have in India, there are only two equity markets in the world, Surabhi, which are expensive. One is the US, the second is India. And there's much we can talk about why these are, two of the best placed economies in the world. But for investors, the challenge is that these are the two richly valued markets. And in the case of India, if you've now got earnings growth tracking in single digit, then, investors do worry about the fact that, it's a big ocean out there in terms of economies. There are other countries where arguably you could look at turnarounds, you could look at cheaper starting valuations, and maybe some upside on growth. So I think what's been missing in India is really that trend in terms of upside surprises. And finally, FY27 earnings growth estimates in India are already at 17%. So, the bar has already been set high. And I'm a bit skeptical about the fact that in an economy where nominal growth is running at 9%, can the corporate sector actually churn out 17% earnings growth in FY27? I think that's a very high bar.
That's an important point, Vetri, that you made. So FY27, and we've been doing this for the last couple of years, right? We start with very high estimates and we keep downgrading through the year. But for FY26 specifically, we again started the year with 12-13%, in some cases 14%, then it came down to about 10% after Q1. You don't expect a double-digit growth this year, despite all the GST cuts, income tax, RBI, all of that?
I doubt it. I'm not sure that will automatically convert. Look, the earnings expectation is about 8 to 9% growth for the current year. I'm not sure there's too much upside surprise to that. Remember that what's happening over here is that you are effectively leaving more money in the wallets of people in both, whether it's the income tax cut or it's the GST cut. And then it's a function of how those people will use it. But let's talk about numbers. The net impact of the GST cut is 48,000 crores. That's the number the government has told you. Now, how much can that actually multiply into your corporate earnings, right? 48,000 crores is a small number in an economy which is $4 trillion. That's just, 0.3% or so of GDP. So there is a limit to which there will be some multiplier, but it cannot be as large as what we are saying. And we need to see what people choose to do with that money, all of which will eventually help the productive economy. But does it necessarily translate into a huge earnings surprise? My simple answer would be no. And that's because look at the construct of the market in terms of the different sectors that drive earnings. Some of these consumption-related sectors are much smaller. So it'll have some buoyancy impact. But, we know that there are other aspects of the economy in the current year which are challenged.
Okay, all right. Hi, Vetri. Good to see you. When, I recall we had chatted earlier this year and you said the RBI has done a bit of a pivot, and now the focus is on growth. How much more headroom do you see for the RBI with regard to rate cuts? Do you believe that we could see another rate cut? Because the RBI, they've turned pro-growth, which is very, very encouraging. However, the credit growth is yet to pick up. So are you optimistic that the credit growth in the system is set for better times in the second half of this year?
So I think you're bang on there, Nigel. The point that I would make is, yes, maybe RBI will have the headroom to do one more rate cut. But to my mind, from a growth perspective, that is not the most critical element anymore. From a growth perspective, what you said is absolutely true. We need to continue to see interbank liquidity being easy, and we need to see a pickup in terms of credit growth. Once again, in a nominal economic environment of 8.5% credit growth, you're barely getting 9% credit growth. I am optimistic that given what RBI has done, not only in terms of making interbank liquidity easy, but also remember they've rolled back some of the harsh steps that they had taken in terms of raising risk weights on many forms of lending, and also, pulling back on some of the interventions that they had done, which were targeted at specific, financial companies and banks. So I think the cumulative impact of that sets you up for stronger credit growth. But it's that stronger credit growth that we need to see. The multiplier could be 1.3, 1.5x nominal GDP growth. It's that acceleration which will eventually cause a power up in earnings. And I also think It's retail lending which holds the key. I don't expect corporate lending to pick up in a hurry.
Just a bunch of other names, right? These are single stocks. Look at, pull up NetWeb. My God, I mean, the April low, when markets sold off on those Liberation Day tariffs, the April low I just looked was on NetWeb was $1,200. It's $3,200 now. And it's a company where I don't think there is any institutional coverage or anything of that sort. And now it's regularly featuring within the top 5 volume traded names on the NSE. So that is NetWeb for you. MobiKwik continues to gain quickly. So it's up another 4% this morning. So 321 here. Bharat Forge has been a bit of an underperformer, but Monday was a super day for Bharat Forge. Was up 7%. Yesterday was quieter. Today it's back up about 4% once again. Prime Focus has finally gotten off the circuit. 3 days on a trot, 10, 10, 10. And today it's taking it a little easy, 1% higher on Prime Focus at 193 on it right now. Sula was up 10% yesterday. I'm not sure there was any news flow. I don't think there was. 3.6, again, a big, completely bombed out name here, which is looking very well right now. So, I mean, just a bunch of things to highlight at this point in time. Vetri, from your perspective and some of these newer, you've got to look for where there is growth. Globally, it's in this AI infrastructure, cloud, etc. There was a newspaper article yesterday, front page, saying that OpenAI is talking to lots of companies in India. Some of them are listed for cloud capacity, data center capacity, etc. I'm not sure how much of what I mentioned with some of these stocks is related to that. But have you looked at that theme? Any ways to play it? Vetri, I don't know if you heard the question. Go on.
I heard that. So I think, you will eventually find that a lot of our classic IT services companies will get involved in implementing, AI solutions for companies. I think many of them have been preparing this for a long time. But of course, the concern on IT companies has also been about the fact that, will their core existing business get hurt by the fact that customers can use AI to actually reduce the outsourcing burden. So these are two conflicting, sort of trajectories that we'll have to keep in mind. But, time and again, and I've been looking at the IT sector in terms of its growth going back all the way to, the mid-90s, 30 years ago. And what we've seen is that every time there is a new wave in information technology, the IT companies have managed to go one level upstream to become the business and solution providers to large enterprises. So I do think with a little bit of a time lag, once you're done with the big investment boom, which is happening in the data centers and, the people working in the core part, once it comes to business solutions, these are the companies which have the domains, and I think they will play a role. Within that, there are a few smaller companies which are arguably better placed, but I think, it's still very early days to be able to say that one or two of these companies have significantly differentiated themselves. But at these starting valuations for IT, I would tend to be more optimistic rather than pessimistic.
Yeah. By the way, so as I was saying that no institutional coverage on NetWeb, I got corrected almost in real time. Somebody sent me a report, a viewer. So in real, that was fast.
The stock has definitely caught investors' imagination and fancy, as seen as a play beyond the obvious, not IT services, but platform.
1,200 to 3,200,
yeah.
Right? And this is from April lows.
And this is telling you the market is so thirsty for any AI-related play, right? Anything when it
supercharged.
When it comes to large language models or AI or any of the new technology. Vetri, before we let you go, finally, I'm coming back to that rather somber note that you gave us, that beyond all the pomp and show of the reforms, don't expect earnings to pick up in a big hurry. So in that context, and what do you do in a market like this? I mean, you've always liked financials, for instance. IT has its own set of woes. FMCG, etc. I don't know if there is a durable pop or pickup. But autos, maybe? I mean, autos, the cut is obviously a little more structural in nature, right? In general, this is not a one-time. Now, the cost of small cars and bikes gets cheaper. Could that be a durable play? But what else do you do in this market if you're not going to get very easy overall index level growth?
So I think the focus at this point has got to be in terms of, where you're getting the best balance of valuations and where you're getting the best sort of potential delta improvement in earnings. And that's the way to go about it. I wish there was some way to continuously sort of rotate between excitement on a daily basis, but that's not the thought process with which we are working in the portfolios. These are sort of attuned to what we think will be longer term growth rates and outcomes for them based on current valuations. So we are not trying to, dramatically change our portfolio allocations. The good news that's come through will help some of our portfolio stocks, and some of the adverse stuff that's happening across the world will hurt some of them. But we are happy to run with a diversified portfolio. But I think the key that one will have to navigate in the next few years is more about sustainable earnings. The last 5 years have been about a dramatic rise in valuations combined with earnings growth. I think we are in an environment where the stock level earnings outcomes will play a much larger role in terms of outcomes. So stock picking and earnings, growth by individual companies will most probably be far more important than just trying to play themes and sectors and rotate out of them.
Okay. All right, Vetri, on that optimistic and pragmatic note, we'll wind it up for today. Thanks so much for joining in. You have a great day, and we look forward to the next call again soon.